S&P 500 is up over 10% in the month of November. But if you were one of the sad sacks that stayed on the sidelines, well, hopefully we have some solutions for you to get you back into the market and help you prepare for 2024. Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and warm Scottsdale, Arizona.
It's like below 80, so I'm wearing a vest.
Very good. And we have a very special guest with us today, Tim Urbanowicz. He is the head of research and strategy at Innovator ETFs, and he's coming to us out of Wheaton, Illinois. Welcome to the program, Tim.
Thanks for having me, Todd. Great to be with you.
Absolutely. Well, I got to talk to you about this market because, I mean, what a roaring market in November. I'm sure you probably have seen a big amount of inflows, I would imagine, into your ETFs this month. But going forward, what do you think for the rest of the year as well as going into 2024?
Yeah, well, I think you hit it on the head, Todd, at the beginning here. A lot of people sitting on the sidelines, a lot of people in cash. We have been hammering the tape saying, hey, you got to be in the equity market right now. And I think that remains the case for the rest of the year. I think if you take a step back and just really evaluate where we are at in this cycle, we are at a point now where we believe you've seen the last hike. I think that is the consensus that the market is coming around to, that hike cycle is over. And if that continues to be the case, like we think it is, that's a very good time to be in equities. If you look at the last 8 hike cycles, right, at the point where we see that final hike, equities have done very well consistently. Average return in the 12 months following the final hike, about 17%, and only one instance, Todd, have we seen the returns on the S&P be negative. That is significant. That is not something you want to be on the sidelines for. I understand the arguments. Yes, there's a lot of headwinds. Yes, you have the recession risk, but it's a good time to be in equities. It has been historically. And might I tell you, even when we see those recession risks materialize.
Yeah, Tim, I can tell you that the people who've been dead wrong, of course, have never changed their tune. I'm not talking about Neuro Rubini, okay, that the world's coming to an end. But, you know, the talking heads that we all know and love have been wrong. I want them to stay that way. One of the things, you know, I'm a little skeptical on historical connections these days, simply because the history we're in right now is so different than any other history that we've had. You know, I was there when the first rate hikes went with Paul Volcker. So, you know, I've been there, done that. No, I know what happens. You're dead right in terms of, you know, I tell Todd all the time, I go back and I save those, you know, the daily highs versus lows. And when we had 6 new highs on October 23rd, I think it was, and 655 new lows.
Yeah,
that pretty much told me that everyone who had to sell, would sell, was scared to sell, was shit in the bed, blah, 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 had already happened. And sure enough, you know, that made a lot of sense. But my question is, we're going to talk about your types of ETFs. But I've been using this word, I called it, you know, what's new this time is sort of the pre-recession idea that companies, you know, that people were so wrong forecasting the recession for so long. It was like waiting for Godot, right? And who never shows up, you know, in case you didn't read that book. Although, you know, I can tell you're an athlete, so it was a book that athletes would read. The whole idea of this pre-recession sort of concept was there was no other recession where we had like a 24-month window saying we're going to have a recession. So businesses could buffer, they could build cash, they could lock in yields, they could get you know, hedges against their yields, et cetera, et cetera, et cetera. So as things are slowing down, it is a surprise to no one. And then on the other hand, the people have just completely missed the whole idea of why the American economy is so strong at the consumer level. A new number I got out yesterday, Todd, was 42% of single-family homes in the United States are owned for cash.
Right.
And I've used that number before because, you know, if you live in California, Arizona, New York, you know, Connecticut, that doesn't seem real. But for the most part, the 63 counties that do 75% of the GDP, the home ownership in those counties is even higher, free and clear. So the mortgage usually doesn't hit them. they're the upper 50%, so the credit issue doesn't hurt them. And then I love the fact that a firm came out yesterday and said, hey, guess what? People are using our buy now, pay later because it's a much better way for them to budget themselves. And so even the people in the bottom quintiles are buying. So people are still shaking their head why this economy is so resilient in the United States. And it's because they don't freaking understand our economy in the United States. You look at Germany now, they're going to be in a recession because guess what? Their manufacturing's down 17%, and it's defense manufacturing 65%, right? That's not us. So I'm with you. I'm with you.
Okay.
Yeah, and I think it's really, you look out there over the last year, everybody's clearly underestimated the effects of the pandemic. They've clearly underestimated the strength of the labor market. I think you still have a lot of these effects where companies are reluctant to lay off workers just because they worked so hard to get those people back to work, a couple of years ago. They don't want to go through that pain again. And you look at the numbers from Black Friday. I mean, if that doesn't tell you that consumers are still strong and still have some gas left in the tank, I don't know what else will tell you that that's the case. And yes, you're seeing signs of them weakening. You don't have the same savings built up that we had a year or two ago. You have more, non-housing debt that's built up, and that may slow them down a little bit. But for us to look out there and say, hey, we're going to have a recession in 2024, I just don't see how that happens given the starting point of where we're at right now. There's still a lot of slack that needs to come out. We still have more job openings than we do workers in this country. Do I think that's going to come out? Yes, but it's going to take time. So it's going to take a lot longer. If that is the end result, it's going to take a lot longer than I think a lot of people think.
Well, yeah, again, I just go to people who've been dead wrong, who every time we have them on our show, I go through the reasons why they've been dead wrong. And then when they come back on our show, they say the exact same thing. So they're just, dyed in the wool, head in the sanders. And God bless them, because, they've scared the hell of a lot of people out of gains. They're sitting on a lot of cash. And then finally, the FOMO at some point comes in, and maybe they'll go into some of your funds, which we'll talk about, because I'm looking at the name, the Buff Laddered Allocation Power Buffer ETF. You got to work on that name, son.
Put down a hashtag.
Yeah, the Power Buffer Step Up Strategy.
Yeah.
How about Defined Outcome? I like that better. I know you have Defined Outcome better. So we'll talk about your stuff, but your forecast for next year for the market.
Yeah, so I think it's really we're anticipating that you're going to see lower total returns overall, but positive. And really, I think it's based on a couple things, just the outlook for both valuations and earnings. So when we look at valuations to start, our anticipation that you're going to continue to see rates higher for longer. We say higher for longer, we mean you see in a 10-year in the 4 to 4.75 range, continuing to fluctuate back and forth there. Right now, you see the market that's pricing about 4 hikes starting early next year. No, sorry, 4 cuts early next year. We don't see that happening. We're in the cost to cutting rates too early is far too great. The Fed made that mistake in 66. They made it again in 80. They're not going to want to make it again next year. So the transition to get there is going to take a little bit longer. And I think valuations are going to need to adjust to reflect that. So we do see valuations coming down slightly from where they're at now. That said, we do still think earnings can grow in the environment. And again, it's going to be an environment of slow growth, but not negative growth, like so many anticipate.
And when you say coming down, are you talking about that PE ratios will be coming down?
PE ratios, that's exactly right. And coming off slightly, right? Yeah. Very, very slightly. So a little bit of a detractor from returns, but then earnings really providing the boost to get us in that 4 to 6% range for next year.
But your forecast for the end of the year is quite bullish. I mean, you're looking at 200 points added to current S&P levels. I mean, we're 1 month away. That's pretty remarkable.
That's for year-end 2024. That's for
okay. All right. I misunderstood.
No,
Tim, I was going to correct him, but it's just more fun to watch him just, step on himself. And so I'm sorry.
So, honey, here's a question though. Do you anticipate a recession next year?
No, we don't. Again, it is a possibility, but given everything we talked about at the beginning, we think that conversation gets kicked down another year. A lot of slack that needs to come out in the labor market. Consumers are still strong. So the hikes are working, but they're going to take more time to get to that point, which is why we say low growth, but not necessarily negative growth. But there is, I do think there's a lot of implications that we need to be paying attention to. I look out there, you see the consensus bottom up saying, 10 to 12% earnings growth next year. We don't see that as necessarily realistic for the environment that we're in. You have to look at this from a couple of reasons. You look at margins, right? Margins have exploded with inflation. They've come down a little bit, but they're still pretty elevated. I do think consumers are still strong, but can companies continue to just pass along these higher prices time and time again? There's going to come a point where they're not going to be able to, right? So I don't think you can just count on the robust margin growth that we've seen here in recent years to continue. So,
well, Todd,
margins that hold steady.
Todd, this is where I step in and say, well, Tim, do you realize that the top 25% of households are responsible for 78% of discretionary spending? So
I do, and there's certainly a gap. But
I mean, that's the buffer. I'm just using your word buffer here. It's a free advertising. The buffer for the economy is the top 25% already has mortgages or doesn't have a mortgage, already has 200,000 plus in household income, plus has $1 million in a 401k and other things. Their spending's not going away. And at the margin, if you remember back to your master's degree in finance, it's the marginal buyer that sets the price. And right now, the marginal buyer in the consumer economy, 76% of our GDP, is doing great. So what that means, when Todd always shakes his head when I say this, that from a pure mathematical standpoint, it doesn't matter that the bottom 50%, are using buy now, pay later, or, their savings have gone down, because on a mathematical basis, their spending could go down 10%, but it wouldn't make a difference, much of a difference in all the GDP. That's my point. And
it's an interesting point, and Tobin, I think if that assumption is correct, I think we need to very much worry about more hikes and inflation continuing to tick higher, because until you see that come down, I don't see a situation where you don't see a second wave of inflation. So
I agree. I mean, I've been saying that the greatest risk is that the top 25%, which I'm grateful to have been in for most of my life, never stops spending. I mean, when there's 5 or 6 figures in your checking account, Domino's Pizza, or yes or no, is not a question. And if every ACH payment from your whatever comes in and it's 15 grand, 25 grand, 30 grand, it doesn't change your spending. Now, if you've got 3 wives, that's a whole nother story, ex-wives. But and I certainly have friends in that camp. And then you take the 30 grand, you divide it by 3. So that's a different story. But thankfully, that's not the dominant part of that world. I will say this though. In Silicon Valley, Todd, I heard somebody say Silicon Valley yesterday on CNBC.
Yes.
I wanted to strangle. In the greater Silicon Valley, one of the reasons why, for instance, one of our favorite stocks, Meta, is up like 125%, is because it got rid of 70,000 people they didn't need. I mean, the average salary is $268,000 that they cut. Now, I may not be a smart man, but if you multiply that by 70, their EPS jumped 400% simply by lowering their overhead, and everybody else has followed that. The highest unemployment rates in the United States right now are Palo Alto, Fremont, et cetera, because everybody lives there, everybody owns their house. They're not going anywhere. Maybe they're working from home, but that economy is never going down. Even after the 2001, right. 2002, yeah, it got shook out a lot, but it bounced right back, and we're not anywhere near that situation. So,
okay,
yeah, I'm with you there.
Okay, well, let's leave it there on this block, guys, because coming up after the break, we're going to ask Tim his thoughts on small caps. I think you'll be shocked to hear his take.
Todd, that may be interesting to you, but I'm going to ask him about Buff laddered allocation power Buff ETFs and defined outcome ETFs, if you don't mind.
Yes, Toby, we will be speaking about ETFs. We're also going to talk about the breaking news that
ETFs.
came
I
out.
don't care about anybody else.
I got it. Yes, we hear you. All right, and we'll also talk about the breaking news out of Omaha today with the passing of Charlie Munger. We'll get into that. So with us today, we have Tim Urbanowicz. He is the head of research and strategy over at Innovator ETFs, and he will be right with us right after the break. Stay with us.
Buy, hold, sell, brought to you by CrossCheck Management.
I mean, yeah, let's talk about
Stop
today where I'm gonna go
Yo.
topics.
Roll it down.
I am.
You don't need a car to listen to Sirius XM. You can listen anywhere. You know that, right?
What? Kevin Hart's Laugh Out Loud Radio.
Kevin, you could use your phone.
What?
Alexa, play Kevin Hart's Laugh Out Loud Radio on Sirius XM.
What?
This is how I know you're getting old. I guess that was it.
Ready
for business.
in brief.
Bloomberg Briefs puts the power of Bloomberg to work for you with over 15 industry-specific newsletters available only by subscription. Each offers proprietary data, researched and written by acknowledged experts. Top analysts, dedicated economists, senior business editors, all presented in a concise, uncluttered environment.
It gives me the edge I need.
Go to BloombergBriefs.com right now for your free 30-day trial.
We give game day a whole new meaning.
Markets have been on a tear this entire month of November, and we still have a few days left. So what should we expect? Well, it looks like all systems go as the markets continue to roar higher. But with us today, we have Tim Urbanowicz. He is the head of research and strategy.
I told you, Tim, he messed it up. I told you. Hello.
So with the and Tim, I got to go to you because on this one, because what you gave in your notes, which really kind of surprised me, was your optimistic view of the small cap sector, and you're really trying to tell investors to start increasing that position for small caps. What's your take on it?
Yeah, I think, Todd, what it really comes down to is the risks that are and are not being priced into the market right now. And I think when you look at small caps, no doubt they face headwinds. Arguably, they face the biggest headwind from higher interest rates. If you look at the amount of floating rate debt they have exposure to, about 40% of the index has exposure to floating rate debt, which is about 4x what we see coming from large caps. So that's a risk. Obviously, the recession risks are present, but a lot of those risks are really priced in right now. And if you look specifically where we see small caps trading relative to their large cap counterparts, we're trading at about a 1.5 to 2 standard deviation difference from where you typically see small caps trade. So
can you tell the audience what a standard deviation is? Because this is not, master's in finance school. So.
It's just the deviation around the mean. What's usual? It's a little bit above that. So you're seeing these stocks trade cheaper relative to where they typically trade to large caps. So there's a lot of value that we see baked in. A lot of those risks are already priced in. So to be able to go out there and cautiously increase exposure to small caps, and we're recommending our outlook doing it via small cap buffered ETFs to have that protection in place in case the recession does play out. We think is prudent right now. They haven't participated in the rally and they've gotten beat up. So it's important to have that exposure. A lot of investors, quite frankly, have given up on them. They're all in on the Mag 7 and out on everything else. Trade's not going to run forever. So really starting to establish or even add to that position in small caps, we think is really important, just given where valuations are. And you want to start establishing the position you want to hold throughout the next bull market.
Well, I'd say first, I'm a growth investor. I frankly almost despise value investing simply because the value people other than the late great Charlie Munger and Mr. Buffett are some of the only people who've ever made it work. I love watching on other business shows the value guy come out and saying, Bob, is it you're there? Is this going to be the year? Because you underperformed the market for 12 years in a row with your small cap and your mid cap value. And then I always ask them, what is the catalyst that would make someone want to pay a higher value or a higher price earnings ratio. And finally they have the answer. Yeah, well, if interest rates come down and the Fed starts cutting, then the present value of those future earnings is going to be worth more, and they do grow faster in theory than the S&P. But don't you have to say that the interest rate's going to be cut before you're going to get a catalyst to get those small caps up in value?
Well, I think that the thought process here is you may not have time to do that once that's the case. So that's why you want to start nibbling on those names now. Again, one of our top ideas that we put in our outlook is ticker KJAN, the small cap 15 buffer ETF. So in the event that you see rates continue to stay high, in the event that you see those recession risks play out, you have that buffer against any losses that play out. You have a 15% protection against losses. So
well, explain that because I found that intriguing.
Yeah.
Without getting all the index futures and everything else you do to create that. I give you $100. What you're saying is that I'm protected on the first 15% downdraft of that $100, correct?
That's exactly right. So yeah, so IWM, which is what we buy options on, so the small cap ETF.
Right.
That ETF, January to January, goes down 0 to 15%. You're fully protected from those losses.
Now, that is the greatest concept I have ever heard. Can you imagine, Todd, if you were a retail rep going to someone and saying, listen, just because of the valuations, this is stupid, ridiculous not to be in. But I have to warn you that because they're small caps, if the Fed doesn't cut these rates, there's a lot of risk. So what if I could put you in the small caps for a year? And even if they went down 15%, you'd still be at zero. And I would then ask the person, are you doing something illegal? No. So how do you do that, Mr. Magic Man?
It's a great question. And it's something that, quite frankly, has not only kept people out of small caps, but it's also kept them out of the market this last year. And they've missed out on a 19% gain. So to be in this strategy, again, the KJAN, 15% buffer, you've got a cap of 21.5%. So where's the free lunch coming in? It's if IWM runs up above that, you're not participating in those gains.
I missed out on 1%. I'm up 21%, but damn it.
Yeah, exactly. But to answer your question, it sounds complex, but it's actually a pretty simple options strategy beneath the hood. So you think about what we're delivering. You get the upside of the index. So we're buying a deep in the money call, which means that call is making money if the market goes up right away, right? So that gives us the 1-to-1 exposure on the upside. Then what we have to do is we have to get that 15% protection in place. So what we do, we buy an at the money put, which gives us that protection right away. We sell a 15% out of the money put. So that's where the protection starts. That's where it stops. And then every layer that we've bought so far has a cost to it. So in order to finance everything we've just paid for, what we simply do is we go out and we trade away our upside. So then we go sell a call
option, call
option at the exact level necessary to offset the cost of the options package that we just purchased on the downside.
And there's some genius behind the wall there that's doing all this, or is it these are computer programs you've already put together?
It is. We know. I mean, we've had hundreds and hundreds of outcome periods completed since 2018. Every single one of them has delivered what we've said, because we know that exactly what the payoffs are going to be in each of those legs of the trade that we have. So we just have to build that package day one. It's set it, and we know that 0 to 15% we're going to be protected. We know where the cap is. So it's actually, I know it sounds complex, but it's actually pretty simple construction underneath that.
And after this interview and $100 million comes in, how long does it take you to cover that $100 million?
Well, I thought you were going to put 150 in after this one. So I don't know.
I got an ex-wife, okay? So it's not going to happen.
Or we put it to work right away. I mean, so we, money comes in, we go out and we continue to add that money to the options package that we've already purchased. We're buying those same exact.
Oh, okay. You're buying the same because it's time certain. So even if those had gone up in value or down in value, you're still buying them?
Exactly. And it doesn't change the outcome for the investor who bought.
Right.
What does change is the investor who buys right now. And what's cool about these strategies is that no matter if you buy day one or day 300, you can always go in with a specific known outcome. So you don't have to guess. You can know, it might not be day one parameters, But you can know, we have a tool on our website that'll show you, okay, if you buy today, you know exactly what upside you have left, you know exactly what buffer you have
Right.
left.
So the upside, you know, every trading day goes down a little bit, right? And so it's because you fixed for the calendar year of 2024, right? And then also though, does the 15% protection is all the way through the year, correct?
It is, yep. So you'll know, and it depends on what the market does, right? So if the market goes up, 10% in the first couple of months, you're going to participate slowly up to that point.
Sure.
But again, you can always go into it and know, okay, this is, if the market does this, this will exactly be what happens. That's my experience.
And one other question, is anybody making options on your ETFs so that if I wanted to, I could, use call options and put options, et cetera?
We don't have a really big market for that right now. There hasn't been a lot of demand for it. Not to say it couldn't happen in the future. I mean, there's a lot of ETFs, especially you look at the big boys like Qs, SPY. I mean, there's robust options markets. There's not on these strategies right now, but if there's demand, and not to say it couldn't develop.
Well, I'm moving my newsletters to a much bigger publisher, and I'll have about 20,000 people that are going to learn about your. Because
there you go.
What I love about it is I can build a core for someone and set it and forget it. Then because you're confident on that, so it's, the old core and explorer, then we can take different risks. We happen to be big in LPG tankers, thank God. And, some of them have gone up 2-3x in the last year. So we're taking profits in those. Well, they were explorer when they were $5. They're like 25% of the entire portfolio. So I can take that up, but they know that their core part is done. I love that. I'm not a paid spokesman.
No, that's exactly right. And I think if you look at like where we've seen a lot of the flows come, one that we have seen huge interest in from advisors is the TJUL. This is the 100% downside buffer. So literally 100% downside protection over a 2-year outcome period with upside to a cap on the S&P of 16.6%. This is one that, we have people calling us saying, hey, this is the only strategy that our clients would use and not go sell out the cash. And they're so thankful that they bought it because the market has run up.
Right.
That's the biggest issue, I think, that people are dealing with right now. It's like, okay, the market's up 19%. How do I get out and sell the cash? And the reality of it is to have to make that call at the right time is nearly impossible because not only do you have to know when to get out, even if you nail that call, you also have to figure out when do I get back
in. Yeah.
Okay. And trying to put those together is impossible.
So tell us, Tim, about some of the maybe some new filings that you guys have submitted for new products coming out, because it sounds like they're quite innovative, to use that word. So do you have anything that's spectacular and exciting that investors should keep an eye out for next year?
Yeah, couple good ones. So in the realm of the 100% downside buffer, we have another January series launching of that one. So that'll be 2 years. So Jan 2024 to 2020, end of 2020.
2 years of 15% downside?
2 years of 100% downside protection.
Oh.
Yeah. So this is again, this is one where it's get your cash off the sidelines, get back into the market, trying to time it. You have 100% downside protection. The cap, we don't know what the new cap will be quite yet, but the one again in the July series is it's about 16.6%. So somewhere in that range. There are a couple factors that impact it, but that'll be a really good one to keep an eye on. I think they're really important, timely for whatever.
And what's the ticker on that one?
That one will be AJAN.
Okay, the AJAN. Well, you just in discovering your company and seeing these, you've just given me a new allocation, because I'm moving a whole bunch of managed accounts right now, and the way I speak to it is, we have growth. And these are growth with catalysts. My company's Transformative Research. We're looking for inflections of growth that are, S-curve, secular, and all that good stuff. That we have high income with some growth, and that's again, that's like these, LPG tankers. I can show you how to make an LPG tanker ETF that pays serious dividends, and if you could put the buffer on it, wow. but that adds a whole new concept to the building of a balanced portfolio. If you have how much money that you do not want to see go down at all, but yet have some upside. All right. Now, how about growth? My people are very experienced investors. They understand nothing goes straight up. Something goes straight up, we sell it. We've told them, for years. And then the income sort of stuff, because the monthly income ETFs now are incredibly interesting. And now that you're my new best friend, I'm going to talk to you about how do we do one of those where we do the monthly income, very high in monthly income, and put a buffer underneath. But I do that now by buying put options on the leveraged underlying stocks, right? So I can create my own, no downside for 2024 with like Tesla with a 55% annualized dividend, and I'm taking 8% of that 55% and rolling that into the put options on those leveraged 2x thing. So that sounds complicated, but not to you, but giving me another bucket of no risk, managed risk money keeps the texts and the phone calls down to a minimum. Trust me.
That's exactly it. And we have a couple income strategies now. Ones that we use a lot in our model allocations. They're a little bit different. They do still have the built-in risk management, but they're barriers instead of buffers. Which, if you're familiar with what a barrier is, we consider that to be soft protection, whereas the buffer is hard protection. So with a buffer, you have a 15% buffer. No matter what, market goes down 80%, you're always going to have that 15% protection. The barrier is a little different, which is you have 100% protection up until the barrier level, but then once that barrier level is breached, you take on 1-for-1 the whole way with the market. So one of a couple of the strategies that we use heavily are we have a 30% and a 40% barrier on the S&P 500, where you're generating high yield like income, but you have a 30% barrier against losses on the S&P. So you look at that. So an example, like one is the April series, the APRJ. That is 30% barrier against losses, April to April. And then you're getting upside, you're getting no upside exposure, but you're getting a income rate of roughly, I think about 7%, 7.3% on that strategy. So as long as the market doesn't go down 30% or more, you have that income.
Yeah, that's interesting. I'm really much more excited about the ones where I'm getting 5-6% monthly. I was just with a client yesterday, and she said, Toby, I just bought a new house. I'm 74 years old. I sold my house for $1 billion, and then I gave that to you. And now the only problem I have is, how do I spend the money? The monthly dividends are choking me. I'm going to be paying taxes at my wazoo. I live in Connecticut. I said,
Right.
Those are rich people problems.
Rich people problems, absolutely.
There's 100 million people out here in America who would love to have that problem.
Yeah, no doubt about that. Well, I know that the audience can go to Innovator ETFs for all of these, for all of your sensational products. This is great stuff. So, and we will also have a description about it for the audience as well. I want to switch topics real quick on the breaking news that came out with the passing of Charlie Munger. He was the vice chairman for Berkshire Hathaway. He passed away this morning peacefully in a California hospital. Toby, I know you have some thoughts. You have a story that you could share with the audience about Mr. Munger.
Charlie Munger, first off, for some reason, most people think he lives in Omaha with Buffett. That's not the case. He lives in Rancho Palos Verdes in LA. I was an LA person for 35 years. And I was a member of the Jonathan Club, which was it used to be a men's club. And then, they broke that up. And Charlie was a member there. And, all 5'1" of them, or 2, maybe if he was stretched that day, would give us talks on lunches. And he would say things that no one ever said about investing. And one idea that I'm doing with my income investing, he used the idea of the snowball. And he had said that whatever your kids have to do, whatever you can do for them, if you can just get $100,000 of money, and then we set up reinvestment of dividends, that they will be a millionaire. If they're starting at 30, they'll be a millionaire at 52.5. And from that talk, I can tell you from friends, it gives me chills just thinking about it. There are thousands of kids, of the guys that I knew from that club, whose kids are multimillionaires at this point because of the, the Munger snowball effect. And I try to teach as many people, and the next book I'm doing, I'm going to be doing an homage to Charlie on this. But I'd love to also work with you on a snowball effect ETF, where it was the reinvested the dividend. You didn't have to go to a registered investment advisor and pay him 2%. But he contributed that idea, and that one idea over the last 55 years has made more people financially successful that didn't know a stock from a bond from a wormhole, but their parents learned it and they taught. And final point was that my friend Greg Dollarhide, who manages all his IRAs, et cetera, for his kids, we're out there last week at his home, and 3 of the kids are millionaires now. They're 38 and 39 years old, and that's from starting the snowball when they were 15.
Wow, incredible, incredible.
So,
wow. Any thoughts, Tim?
No, I think it's the passing of a legend, and it's really cool to hear everything that he's done and accomplished, and to your point, Tobin, just the simple compounding of interest and dividends is key, and he kept it simple. It was always easy to understand, always easy to hear what he called it like it was, which I always appreciated. So he'll definitely be missed.
Yeah, you got that right. Yeah, that time value of money definitely is exceptionally valuable for any
compounded time value of money.
Yeah, compounded. There you go. There you go. Well, we're going to leave it there, guys. So on behalf of Tim Urbanowicz, you can go to innovatoretfs.com for all of Tim's the commentary, as well as I'll take a look at the products that they're offering at Innovative. You definitely will be it will be well deserved for your portfolio to take a look at. That's for sure. So, but with Tim, we want to thank you for joining us today on Buy, Hold, Sell. We'd love to have you back, especially when those new products come out next year.
Great to do. Good love to do it.
Absolutely. All right, so on behalf of Tim Urbanowicz and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care. All right.
Buy, Hold, Sell, brought to you by CrossCheck Management.